Hi once again, Kevin Turner from Real Estate Talk. And of course, the RBA have flagged that interest rates are probably going to be on hold for the foreseeable future, raising a number of questions from investors, certainly getting them. And I know my guest is as well, saying, well, if the RBA are saying that, why are my interest rates going up? Andrew Myrams from Intuitive Finance joins us. Andrew, no doubt that's a question you're getting as well.
Very frequently, Kevin. Yes, hello. It seems to be the flavour of the month. All the news says that the Reserve Bank's not going to raise rates anytime soon, but now everyone's getting their letters and advice in the mail and everything like that. It's all over the news that rates are going up. So we've seen all the majors, and now we're starting to see most of the minor lenders start to increase rates in some way, shape or form, specifically targeting investors, but we've also had home loan interest rates rising for the first time.
I see a lot of concern also. I'd love to get your comment on this about interest-only loans. And a number of banks or a number of commentators saying that a number of banks are overloaded with them. What's your view on that, Andrew?
Yeah, well, rates are going up. And so the two reasons that rates are going up are really there's some regulatory requirements. So APRA and ASIC, again, as part of their tightening, are making the banks hold more capital aside for the investment loans and those loans that are actually flagged for investment or interest only, which has generally got an investment tune to it. So they're being asked to put more buffer or capital aside to fund those. So that comes at a cost. If they can't lend it out and they've got to hold it, that comes at a cost. But I think there's been a lot. It's easy to blame the regulators. The reality is that around the world, interest rates are rising. We've got a little bit of the Trump factor. We've got a little bit of a whole range of factors that are seeing our yields across the world raise. Now, Australia can no longer raise enough money with savings and things like that held by the lenders. So they have to get their capital largely from overseas and around the world to stock up their balance sheets. And that's now coming at a dearer cost. That's the real reason that our interest rates are starting to increase. It's just the cost of money around the world.
There's always a bit of a lag too, isn't there? When interest rates do go up or there's a bigger call on investors, they then have to obviously put the rental rates up on their investment properties. Do you see that happening quickly, or is that just a slow creep, Andrew?
I think it'll be a slow creep. I mean, we're talking about Australians are very, very complacent when it comes to their interest rates. So we've seen them coming down for so long and we've all got complacent. All of a sudden now we've got a 0.25% rise, or we've had through the back of last year, we had a couple of minor incremental increases with investors and interest-only loans. Now we're starting to see them go up. And now everyone's up in arms. Well, I guess if 3 years ago, Kevin, I'd offered you an investment loan rate at still 4.5% to 4.75%, you'd have jumped at the chance. So I guess it's just managing expectations at the moment. Will that increase rents? Well, that's probably more market driven than interest rate driven, I think, their ability to do so.
Fair comment. Just a closing point, if I may, Andrew, buffers. What sort of a buffer are the banks building in now with the prospect of rates going up?
As in our servicing buffers and
Yes.
things like that?
Yes.
Yeah. So it's still, those haven't changed even for the last 2 or 3 interest rate decreases. Most servicing rates are somewhere between 7.25% to 8%. So that's the reality. That's what the lenders are bound to through APRA, looking at, making sure that there's a responsible lending slant to all the lending that's going on at the moment. We don't want to be overheating the market. We don't want to be putting people at risk of overcommitting themselves if and when rates start to go up, and we're seeing the start of it now. So yeah, there's still a fair marginal buffer in there. That's just the reality of the world today.
Are they the figures you work on when you're doing your sums for someone?
Yeah, 7.5 is about the average rate we tend to use. So 7.5, and then over a 25-year loan term. That's about the servicing rate for what we have to do now for everyone.
And you likely to change that in the months ahead, Andrew?
I wouldn't have thought anytime soon. I still think, it's going to be a good while till we've got rates actually at 7.5%. But that's the buffer that they're being asked to. APRA have sort of flagged this week that they might start increasing that to 8 and 8.5 and making the banks do that. They're obviously concerned with two in particular markets, Melbourne and Sydney, continuing to power along and they're determined to try and take the heat out of the market and not put people at risk of rushing in. That FOMO effect of people rushing in and putting themselves at risk just so they don't miss out.
Good talking to you, Andrew Myrons from Intuitive Finance. We'll catch you again soon, mate. Thank you.
No worries, Kevin. Thanks.